92,000 in, 10.1 million out. Sounds like an outstanding investment. Wrong. Elizabeth Taylor bought in 1963 a Van Gogh at an auction for £92,000 sterling, and it was sold 49 years later for 10.1 million. If you divide the return by 49 years, it looks like something like more than 200% per year. But that's not how investment returns are calculated. Compound properly and you will end up with a more moderate annual return of around 10%. Sounds still great, right? But if you had invested the £92,000 in the S&P 500 in 1963 and all the dividends reinvested, and considering the long-term devaluation of the British pound, you would have ended up with a value of £15 million. So the equity index had beaten the Van Gogh. And even for a US investor without currency effects, the return from the equity investment would have been very close to that of the Van Gogh before costs. And the costs were substantial. Insurance, storage, and in Taylor's case, a long-lasting battle over the ownership of this painting. And there's another problem. Art is completely indivisible. You can't simply sell off a corner of a Van Gogh if you want to pay your grocery bill. In contrast, equity is divisible. You can always even sell a single share if you need cash. Sure, the view is priceless, but would you rather own a canvas that gives you a headache or a well-diversified portfolio? The moral, huge gains look spectacular until you annualize them and count the costs.